Would you like to invest in the best business you'll ever see? Want to collect the safest dividend in the world? Like the idea of a company compounding your wealth and passive income at double-digit rates while you sleep? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I want to tell you about a stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing the world with incredibly valuable software and hardware products and services. Our world is starting to become dominated by technology. You can ignore this and get left behind, or you can jump on board and make some money. This company offers you the chance to do the latter. That's because they're growing at a double-digit rate and paying out the safest dividend I've ever seen. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Microsoft Corporation, which appear to be trading at a significant discount today. Microsoft Corporation, stock ticker MSFT, is a global technology company that provides a range of hardware and software products and services. Founded in 1975, Microsoft is now a $1.9 trillion by market cap technology leviathan that employs more than 160,000 people. Fiscal year 2020 revenue can be broken down across the following three business segments: intelligent cloud, 34%, more personal computing, 34%, and productivity and business processes, 32%. Some of the company's primary products and services include Windows operating software, Azure Intelligent Cloud, Office software, the Xbox gaming system, LinkedIn, and Surface computers and tablets. In a world that's quickly becoming dominated by technology, Microsoft has become one of the very biggest and best technology companies. Once heavily reliant on software through their massively popular Windows OS, Microsoft has adeptly transformed itself into a major player in areas like enterprise solutions, networking, cloud computing, gaming, and even entire computer systems. Moreover, that breadth is only increasing. They've broadened out their gaming strategy with the recent $7.5 billion acquisition of ZeniMax Media, which is the parent company of game publisher Bethesda Softworks. This gives them more content production power in an industry that has a very bright future. Gaming is an industry that's bigger than Hollywood at this point. Adding to their suite of offerings in that area, the company is also reportedly in discussions to acquire Discord, a group chat that's often used for live streaming games. Simultaneously to this gaming build-out, Microsoft is also scooping up tech contracts with the US military. One of the world's biggest technology companies is also becoming a major defense contractor. That's a game changer. Microsoft recently announced that it signed a $22 billion contract with the US Army to provide HoloLens augmented reality headsets. That comes on top of the $10 billion Jedi contract that Microsoft won in 2019, which is currently being fought in court. All of this bodes incredibly well for Microsoft to defy the gravity of its huge size and continue growing its profit and dividend at a brisk pace. Microsoft has increased its dividend for 19 consecutive years already. The 10-year dividend growth rate of 14.3% offers plenty to like, and with a payout ratio of 33.3%, this dividend is extremely safe. I see plenty of dividend growth ahead. However, the stock's low yield of 0.9% does leave something to be desired. This isn't an income play. It's instead a long-term compounder, which makes it perfect for younger investors who have time to let that compounding process play out. These dividend metrics are some of the best you'll find. I think Microsoft has the safest dividend in the world. Looking at business growth, Microsoft grew its revenue from $69.943 billion in fiscal year 2011 to $143.015 billion in fiscal year 2020. That's a compound annual growth rate of 8.27%. Now, not all this growth was organic. Microsoft has been acquisitive. The 2016 $26.2 billion acquisition of LinkedIn is particularly notable. However, I still see this as very impressive top-line growth for a large business like this. To compound a revenue base of almost $70 billion at more than 8% annually is Herculean. Meanwhile, earnings per share increased from $2.69 to $5.76 over this period, which is a compound annual growth rate of 8.83%. Share buybacks helped to propel some of this excess bottom line growth. Microsoft reduced the float by about 10.5% over the last decade. This would be impressive earnings per share growth for any business. It's particularly impressive for a business of this size. But wait, there's more. Microsoft is in many ways a much better business today than it was a decade ago, and their growth is actually accelerating. If we look at earnings per share growth over just the last 5 years, earnings per share compounded at an annual rate of more than 22%. Satya Nadella took over as CEO in 2014, and he's performed nothing short of miracles. Looking forward, CFRA is forecasting that Microsoft will compound its earnings per share at an annual rate of 21% over the next 3 years. That would be right in line with what Microsoft has done over the last 5 years. Furthermore, their most recent quarter, which was the second quarter of fiscal year 2021, showed an amazing 34% year-over-year increase in earnings per share. This was largely driven by Microsoft's key cloud platform, Azure, which showed 50% year-over-year revenue growth. Cloud computing is a megatrend. Amazon.com Inc. runs market leader AWS, but Azure is second in the marketplace and closing in. Meanwhile, Microsoft commands an estimated 83% of global market share for the PC operating systems. As global computing goes, so goes Microsoft. I view CFRA's forecast as reasonable. Ordinarily, it'd be hard to accept this kind of growth projection from a company that's working with such massive numbers. The law of large numbers would seemingly limit them, but Microsoft is one of those rare, exceptional businesses. This kind of growth can easily fund double-digit dividend growth for the foreseeable future, especially in light of the payout ratio being so low. Moving over to the balance sheet, the company maintains one of the cleanest financial positions I've ever seen. Their long-term debt-to-equity ratio is 0.50, while the interest coverage ratio is over 21. Furthermore, the company has over $135 billion in total cash on the balance sheet. That's larger than the market cap of many Fortune 500 companies on its own, and it covers the long-term debt more than twice over. This is why it's one of only 2 companies in the world with a credit rating of AAA from Standard & Poor's. Profitability is extremely robust, as you might expect. Over the last 5 years, the firm has averaged annual net margin of 23.72% and annual return on equity of 30.5%. Microsoft is almost the perfect business. It's practically flawless, and as difficult as it might be to believe, their best days are likely yet ahead. Plus, the company is protected by durable competitive advantages that include global scale, switching costs, patents, R&D, and IP. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Their very business model is in some ways a risk. Technology changes fast, and large companies can become disrupted. Microsoft must remain flexible and adaptive. As broad as the business is, they missed the boat in several huge addressable markets. Mobile is an example. Their sheer size and maturity of the business is also a risk. At some point, it would seem that their absolute size will limit relative growth. Overall, I'm highly optimistic about Microsoft's long-term prospects. That optimism is somewhat bolstered by the valuation, which isn't as high as it arguably should be. The stock's PE ratio of 36.9 might look high at first glance, but one of the very best businesses on the planet deserves a high multiple. If CFRA's earnings per share growth forecast holds true, the PEG ratio is well below 2. In addition, this price-to-earnings ratio isn't far away from Microsoft's own 5-year average PE ratio of 36.4. Paying a premium compared to where it's typically been on average over the last 5 years doesn't strike me as imprudent. That's because the company is clearly firing on all cylinders and is in many ways better now than it was at any point over the last 5 years. I've been hearing investors complain about Microsoft's valuation for years. All the stock has done is climb higher. It's up more than 350% over the last 5 years, causing many investors to miss the boat. I valued shares using a dividend discount model analysis with a 2-stage dividend discount model analysis. The 2-stage analysis accounts for the current high rate of growth and the eventual slowing of that growth. I factored in an 10% discount rate a 15-year dividend growth rate of 15%, and a long-term dividend growth rate of 8%. This dividend discount model analysis assumes that the 10-year dividend growth rate repeats itself for the next 15 years. That's not unreasonable when looking at the recent earnings per share growth, near-term growth forecast, low payout ratio, and incredible balance sheet flexibility. If Microsoft could manage near 15% dividend growth over the last decade, I see no reason why they can't do at least that well over the next 10 plus years. The terminal dividend growth rate of 8% is at the top end of what I usually allow for, but if there's any business that earns the benefit of the doubt, it's this business. The dividend discount model analysis gives me a fair value of $284.46. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Microsoft as a 3-star stock with a fair value estimate of $263. CFRA rates Microsoft as a 5-star strong buy with a 12-month target price of $280. I came out almost exactly where CFRA is at. Averaging the three numbers out gives us a final valuation of $275.82, which would indicate the stock is possibly 11% undervalued. Here's the bottom line, guys. Microsoft Corporation is one of the highest quality and most impressive businesses I've ever seen. Despite their sheer size, they're growing faster than ever and getting better as they get bigger, with an extremely low payout ratio, double-digit dividend growth, 19 consecutive years of dividend raises, and the potential that shares are 11% undervalued. This dividend growth stock is perfect for investors who have time to let it magically compound their wealth and passive income for them. And now for a special news announcement. Argus Research just increased its price target on Williams-Sonoma Inc., stock ticker WSM, to $205 from $185. Our recent video highlighting Williams-Sonoma as one of the best stocks to benefit from stimulus checks was shot when the stock was $160 a share. The stock is now coming up on $190 a share, and it's likely headed higher. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.